The Cheesecake Factory, a company focused on upscale casual dining, whose main restaurant is not just cheesecakes and dessert, but Louisiana chicken, jambalaya, and so much more. However, this company isn't solely defined by just this one name. It's currently expanding two restaurant concepts, North Italia and Flower Child, and experimenting with many, many more, diversifying its way into other food niches. As such, the company has a surprising number of growth opportunities through these concepts, making it a strong choice for people willing to take moderate risk with a solid growth potential. There's also a dividend, which is pretty nice. So first, let's look at the business models and the concepts. So first, our concept is the Cheesecake Factory. It has about a 61% of the total share of all their business, and its average ticket size is $31 per person. So they do have a higher sales per square foot compared to other restaurants in the same industry, which we'll see later, but their construction cost is higher at the same time. They also have a very large unit size. The goal of this restaurant is to put it into high traffic areas such as malls, making it flexible in the context that it can fit in many different types of malls. For example, over here, we've got the outdoor dining, and we've also got indoor dining. And we have different things like here's the mall on the left, and we've got really high ceilings to adapt to the mall's design. In addition, the Cheesecake Factory has been expanding its way into more takeout options for customers because upscale dining popularity has started to decline in recent years, although not too quickly or else the company would bankrupt, but it is declining. So they are adapting to have more takeout options. They're adapting to be selling their famous brown bread all over stores everywhere. And they're also expanding their other concepts, which we'll see in a bit. So here is North Italia. North Italia takes about 12% of all their share in these concepts. It's got a higher check size for lunch and dinner. And it's also upscale casual, but it's more of an Italian restaurant. So as we see, they have about the same sales per square foot. Although here it does say productive square foot. I'm not actually sure the difference between productive and the regular that they're using in Cheesecake Factory, like what constitutes as a productive square foot. So maybe take that number with a bit of a grain of salt. However, the point here is that the construction cost per square foot is a lot cheaper than the Cheesecake Factory by about $300, which is pretty significant considering the large size of these restaurants, about 7,000 square feet. And this is one of their earlier brands, and so they have a 20% annual growth rate, and their goal is to hit 200 locations. And now if we look back at the Cheesecake Factory, they have 215 locations already. So they're trying to expand this to be a little bit smaller than Cheesecake Factory, but almost as big of an operation. And the reason why this is good is because their construction cost is a lot smaller, meaning they can expand it faster, and they're still getting the same amount of money per square foot. This is where they're going to expand their upscale casual section of the business. And then finally, we've got Flower Child. Now, Flower Child is the really big one here because it's a fast casual business instead of upscale casual. It shows that the Cheesecake Factory is expanding into more niches rather than just upscale casual, which allows them to adapt to the changing economy, like I said, with North Italia. And here's the one really important thing to note here. Their long-term goal is 700 locations. And yes, this is a really aggressive plan. It's really risky, but it shows that they have true belief in this section of the business in the expansion into fast casual. This shows that they're really determined in trying to get out of upscale or to diversify into more different niches in order to combat the rising popularity of fast casual. Because if you can't beat them, just join them. In addition, they've got smaller unit sizes, which means it's easier to expand. They have smaller construction costs, and they even have higher sales per square foot in comparison to the other restaurants with a smaller average check size. This means that they have more customers and, in fact, more repeating customers at their current location. In fact, people will say that they return about once a week to Flower Child, at least for specifically returning customers. Meanwhile, returning customers for the Cheesecake Factory only choose to go during special occasions, so maybe at most like once a month. The final thing of the business is Fox Restaurant Concepts, and this is actually a group of restaurants, about 10 or so, and this isn't really for profitability. It's more to see what ideas work and what ideas don't. The growth rate is smaller in comparison to North Italia and Flower Child, but it's still there because, of course, if you can find the next breakout item or breakout concept, then it can make the company lots of money. So I wouldn't pay too much attention to restaurant concepts, but in the future, if one of these does start getting expanded, then that could be a good sign for the company. So the key takeaways here is that Cheesecake has a higher sales per square foot than other upscale casuals, and it has a higher unit volume, meaning that it makes more money per restaurant. And also, it has a moderate average check, meaning that more people are returning to it rather than just a few people buying very expensive meals. It's just more people overall are going to the Cheesecake Factory. While it does have a higher construction cost, that's the reason they're expanding North Italia, because North Italia is generating about the same cost per square foot, but it has a cheaper construction cost. In addition, we have Flower Child, which is providing diversification into the fast casual industry, which is helping it to compete with the current market demand. Next, let's look at the human capital. And with the human capital, we see that they're the Fortune 100 best companies to work for, and it's actually been going along for 11 consecutive years. And for the people's company that care, that's been for 4 consecutive years. So they have a very good hospitality business. Like, they have a really good hospitality and culture within Cheesecake Factory itself. And this is really important for restaurants because it keeps customers happy, keeps customers recommending them out of word of mouth to other potential customers. This is important because Cheesecake Factory spends very little on actual marketing and relies on that word of mouth to spread. And so by having good customer feedback, it allows their advertising plans, which is not having one at all, to work a lot better. All right, finally, let's look at our financials. So if we look at our income statement, we can see here that the revenues are growing every year, which is good. And they also, more importantly, have growing margins, which is also really good. However, the problem is that they are comparatively weak in the margins compared to other similar companies. For example, Durden, which is the company that owns Olive Garden, or Ruth Chris, other companies like that, they have a very high gross margin, which just means that they're making more bang for their buck, essentially. But the reason for this is because Durden is a more established company. Rather than expanding their operations, they're trying to double down on cutting costs at the operations that they currently have. Meanwhile, Cheesecake, as we said before, they're expanding Flower Child, they're expanding North Italia, they're expanding their Fox restaurant concepts. And so therefore, they're having a lot smaller margins. And if we look here, their revenue is a lot lower than them, which is why it's important for them to be expanding. Same thing for Texas Roadhouse and Eat. I think that's Brinker. They're more in the expanding their operations that they currently have instead of growing new concepts. So next up, we can look at the balance sheet. So over here, we can see that we have growing assets and they're outpacing the liabilities, which is good. And over here, when we look at the net debt to EBITDA, they have a larger one at that, which means it's a little bit more risky. They are taking on more debt than they should be. However, it is manageable. It's not like a crazy high number like Brinker is on the right. So that's okay. That's okay to see. It's not too risky. It's more like a comfortable spot. But if you're looking for a safer investment, then I would recommend checking out Texas Roadhouse. Instead, they're similar, but they just aren't. I don't feel like they have as high of a growth potential in comparison. So let's also look at the ROE. The ROE isn't about in line with the other companies, except Eat has like really low shareholder value. That's why it's super high. And while the PP&E over revenue isn't the best, it's definitely manageable. It's not astounding. So their balance sheet isn't as strong as the other companies, but it's not weak either. They still have a good amount of leeway. And finally, if we look at our cash flow, we've got a pretty comfortable amount of free cash flow, which is probably the most important thing. If we see over here, we see that the percentage of the free cash flow that's being spent on paying back investors is declining, which is actually good, because when our percentage of free cash flow is too high, above 100%, it's very unsustainable for the company, because it means they're spending more than they actually have of their free cash flow trying to pay back investors. So seeing that we have less treasury stock being purchased, which is like less stock buybacks, and we now have a below 100% FCF spent on the consumer, we know that they're spending the rest of the free cash flow on things like debt or to expand the company even more, which is good. It means that the company cares about its investors, but they also care enough to expand themselves and not just focus solely on pleasing the investors. And finally, we can look at the valuation. So over here, if you look at our trailing and forward PE, our trailing is lower than the rest of them, and so it's not overly expensive. It's at a pretty decent price right now. In comparison to like Texas Roadhouse is insanely overpriced right now. It is a strong brand, but it's really highly priced. All right, so it's important that we go over the risks. So with Cheesecake Factory, of course, if the Flower Child expansions are not successful or we're too slow to beat like the declining upscale casual market, then things could go badly, right? And the weaker financials mean that the company is more at risk if something bad were to happen globally, like even worse tariffs. So currently, if they've been battling the tariffs and it hasn't been too big of a deal because their menu prices haven't gone up too much. However, of course, there are other global events that could happen that could be bad considering their weaker financials compared to competitors. But however, they're not too weak, so it's not the biggest deal. So in conclusion, the Cheesecake Factory, it's adapting and trying to set itself in reaction to the fact that the dine-in environment right now is declining and that we need to have a bigger shift into the fast casual instead. And it has an above average expansion, meaning that it has a lot more growth potential compared to other things inside the industry. And of course, the big thing that we're looking at expanding here is Flower Child, as it has that new niche that they haven't gone into before, but it's becoming really, really profitable. Now, we have to note that their financials are weaker than other companies, but that's because that they are in the expansion phase. Again, it is a more risky investment with a higher return potential. And again, Flower Child. Pay attention to that because that is the biggest win condition for this company. So yeah, that's Cheesecake Factory. If you're considering buying the stock, let me know in the comments, and I hope that this video helped you with your day. Goodbye. Be sure to subscribe and like the video.